Hello, and welcome to another episode of my Company Health Check series. For those who have not watched my previous episodes or series, do remember to check them out in my channel. And of course, remember, smash the subscribe button and like. I'll really appreciate it. Alright, what is the Company Health Check series? Here I will share my occasional updates on my portfolio companies I invested in and am still currently holding. I will also analyze them using the bottom-up approach, usually by looking at the quarterly reports all the way to the full year and beyond. I believe that by journaling my research in video format, I hope that I can make myself more informed of my past decisions, be it right or wrong, and also share my insights with everyone here. Hopefully, all of us can benefit in some way, especially to my fellow value investors like myself. So if you have comments or any feedback, do remember to share and comment below. Alright, I'll really appreciate it, and we can share and discuss more about what we've looked at today, or be it any other episodes that you watched. So why Kraft? Okay, just to let you know that Kraft has announced their second quarter 2023 earnings in August, and I've purchased Kraft shares last week because Kraft has recently had a huge sell-off. So I usually create myself a framework to screen good businesses to target by using the SWOT analysis. I believe some of you have heard of the SWOT analysis before. If you haven't, SWOT analysis is a strength, weaknesses, opportunities, and threat framework. This analysis test separates all the business characteristics into different pillars, and I'll counter them by asking the fundamental why question. Only if I can safely counter most of them, that I will be able to likely invest in the business for the long haul. I like KAC because of its defensive nature. It has a long-established portfolio of well-known FMCG brands or fast-moving consumer good brands under its belt. So KAC, or Kraft Heinz, has operated both in the US and the rest of the world. So it has businesses in both US and the rest of the world. Its solutions range from ready-to-make sauces, dried foodstuffs, instant food, infant nutritional food, health foods, and so on. You can find most of its products sold in any supermarket anywhere in the world, where you're currently living in. The depth and the breadth of KAC is wide, offering solutions to the FMCG business and give KAC a huge scale of brand leverage and competitiveness. Therefore, this leads to a strong goodwill factor for KAC, and it's one very key important factor and strength for the KAC business. However, let's look at KAC's weaknesses. So KAC's weaknesses is that the FMCG business is where KAC is operating in have generally lower net profit margins and gross margins, and this is due to the intense competition and many alternatives to choose from. High distribution and staff costs also easily eat up margins. Therefore, as an investor, we should have to accept smaller and slower returns if we invest into a business like KAC. Fortunately for KAC, as mentioned earlier, KAC has built up a very strong portfolio of brands over the many decades, coupled with strong distribution network and reach globally. It can leverage on this expertise and scale profitably despite having lower net profit margins. For the opportunities, KAC is a low capital intensive business because equipment and machines are purchased one-off and depreciated over their lifetimes. Revenues are usually already accretive once the raw inventory has been processed into finished goods, ready to be shipped. Low capital intensive business will also bring about free operating cash flows that can be used to redeem debt, pay consistent dividends, or buy back shares. KAC usually pays very good and consistent dividends instead of buying back shares. Today, it has a dividend yield that stands at about 4.8%. However, inventory estimation has its risks for KAC. I noted that KAC has quite low inventory turnover indicating more stock sitting in inventory rather than moving out. This could mean higher wastage due to inventory expiries. The threats for KHC include the ease of barrier to entry is low for a business like KHC in the FMCG market. The FMCG market is flooded with products every day. The bid to win consumers by heavy advertising and offering promotions and discounts is present everywhere, every day. This will result in price wars and reduced margins. KHC thankfully has already a huge portfolio of products and solutions globally. Their decades of hard work in branding and marketing makes consumers already familiar with the brands, therefore creating a continuous revenue churn with lesser need for intensive marketing dollars and to acquire more customers going forward. Let's now look at KHC's segmented revenues for Q2 2023. The top three largest share of revenue for KHC is number 1, Taste Elevation, number 2, sorry about that, number 2, Fast Fresh Meals, and Easy Meals Made Better. These three divisions generate the largest share of revenue in the platform segmented businesses for KHC. So KHC's Taste Elevation focuses on sauces and condiments. This is the largest division, and this division performed very well with the strongest quarterly year-on-year growth of 10.86% and 6 months ended year-on-year growth of 12.6%. This is due to the latest acquisition of Hammer Foods in Brazil, completed in 2022, to fuel growth for sauces and the condiments business across the emerging markets. Fast Fresh Meals focuses on convenient, ready-to-eat fresh meals. This declined 4.8% this quarter and 1.9% for the last, and increased slightly by 1.9% for the 6 months ended. Easy Meals focuses on instant food products and holds 18% revenue share. This is the third largest, but it declined slightly this quarter and is up 3.6% if we looked at the 6 months ended. The overall portfolio seen a slight increase of 2.48% this quarter and 4.6% for the 6 months ended 2023. The main concern for the majority of declines for most of its segments, as you can see here, is generally due to cost and price increases within the industry that have affected sales in the near term. If you look at the below table, the segmented revenue by product category, this comparison we note is based on 4 major segments that gives KHC the largest revenue shares. First is sauces and condiments with their Taste Elevation portfolio, which is consistent with the platform analysis that I mentioned below, that I mentioned above. And then comes the cheese and dairy division. And then after that, third is ambient foods, which include the canned products. And fourth is frozen and chilled foods. You can see here that the gap is quite large for the revenue shares from the number 1 revenue generator, which is the sauces and condiments, and versus the other top 4 contributors. So you can see that 35% is for the sauces division, and then it will go down to 13% to the cheese and dairy division and so on. So there's this huge, large gap. Therefore, this gap represents the strength in KHC portfolio that seem to be in sauces and condiments business. Here I put up Campbell's Soup's segmented revenues as a comparison to its peer. So this is a competitor analysis for KHC versus Campbell. Campbell's market cap is at $12 billion to date, while KHC is sitting at $40 billion, $40 billion. All segments of Campbell show an increase, with snacks showing the largest increase. Recall, however, that KHC in the previous slides, that KHC instead showed a decline in the same snacks division this quarter, while you can see here that Campbell actually showed an increase. Overall, Campbell has shown an increase in revenue of 9.8% versus only a 4.6% increase for KHC. Inventory turnover seems to be performing better than KHC too, at 4%, 4 times for Campbell versus just 2 times for KHC. Excuse me. Campbell seems to be coming into a good value territory as well. But if we looked at Campbell's median price earnings ratio versus KHC's median price earnings ratio and its current prices, KHC seems to be performing in a more oversold territory compared to Campbell. My overall consensus is that Campbell is seen to be definitely better in business fundamentally compared to KHC to date. Let's now take a look at KHC's management outlook for the year. KHC has elected a new CEO, Carlos Abrahams Rivera, that will take over the reins from current CEO Miguel, who was with the company since 2019. Carlos will take over effective 1st January 2024. I think that current CEO Miguel's resignation did not last. His reign did not last because of his resignation recently, and this could be due to the continued poor performance of KHC business that led to him stepping down. KHC's share price has fallen 15% this year, while the broader S&P index has gone up instead of 16%, indicating severe underperformance for KHC. KHC also incurred a $100 million realized loss on the sale of 2 businesses in the first half of 2023, and this already included FX losses on the sale. Coupled with increased business margin squeeze, the incoming change of management, and realized losses on some of its business units, all these factors have likely pushed the share price further down to date. Current CEO Miguel, however, has reiterated that the expected outlook for the full year in terms of sales growth remain at the 4 to 6% range, while the full year earnings per share will be around the $2.83 to $2.91 per share range. The full year earnings will include a negative impact due to post-retirement benefit costs and FX headwind costs of at least 2% to its total full year in earnings this year. Barring for any uncertainties, however, I've estimated KHC's full year earnings per share estimates at the $2.70 to $2.80 range for my valuations. I've tracked KHC sales from 2006 to the latest 6 months ended 2023. Net profit margins for KHC is mostly in the mid to high single digit regions historically. During the financial crisis in 2009 to 2011, they still managed to maintain a high single digit net profit margins. Also, during the COVID period in 2022, KHC still managed to pull in a net profit margin of 8.92%, and this is still impressive if we compare to its own median average. This gives KHC a defensive edge during crises like these. If we looked at this year's P&L or the 2023 6 months trailing P&L, you can see an impressive improvement in its net profit margins to date of 13.9%. This might be due to the better cost controls, as we note that the selling and general admin expenses have declined 28%. And there is also no intangible asset impairment losses booked so far this year. Overall, the P&L seems to be pretty resilient for KHC. As for the balance sheet, KHC's debt position is indeed large at $114 billion as at June 2023. Debt is standing at 2 times its shareholders' equity as at June 2023. I noted that some debt had been redeemed last year, and we see that its debt position fall 4% to date. But still, debt relative to shareholders' equity remains large and worrisome. I also noted an improvement for times interest earned ratio from 3 times last year to 5 times in 2023, indicating more comfort in servicing their interest payments this year for KHC. As a FMCG retail business, it is also important to look at how KHC manages the inventory. I noted that KHC's inventory turnover for their finished goods improved 1.7% year-on-year to 2 times inventory turnover for the current 6 months ended 2023. As we recall from our competitor analysis with Campbell, this still pales in comparison with Campbell and indicates slower inventory improvement as compared to our competitor Campbell. Historically, KAC's net ROA seemed to be very strong in the double digits, but since 2022, the net ROA have declined severely to the single digits. This is due to its excess debt it has taken on during the recent years. For its cash flow, KAC has generated $1.1 billion worth of cash flows this quarter, or 36 times its current valuation. This is on the back of $500 million worth of capital expenditure expensed out so far this year. Because of its strong free cash flows, management have decided to continue paying a dividend of 40 cents this quarter per share. This is a 4.8% yield to its current share price. KHC's current forward PE multiples is sitting at 12 times, while its median PE is at 20 times. The industry's price earning multiples, however, is sitting at 22 times forward. It's forward. Based on my PE forward valuation metric for KHC share price to me should be sitting around the $50 to $56 range this moment. Overall, the industry, based on its forward PE, seems to be fairly valued according to the economy and broader index. But KHC share price, however, seems to be largely oversold due to its uncertainties underlying the business and also the weaker performance if we compare this to peers like Campbell. As I mentioned earlier, Campbell's is indeed a better performer compared to KHC. But KHC declines seem to be sharper than Campbell and thus provides an investment opportunity. My discounted cash flow or DCF valuation sets KHC's price at a conservative valuation of $25 per share, and this is only a premium of 21% above its current price, or 1.1 times its forward 2023 revenues. To me, this is an indication here that it is a strong buy at current prices. Should we ignore the poorer prospects if we compare this to our peer Campbell? Of course, we cannot be certain of what the future holds for KHC, and I will not be able to advise you whether you should buy or sell this stock, as everyone's risk perspective is entirely different. In conclusion, I think that the benefits here have outweighed the risks. As to me, KHC is currently selling at very close to my margin of safety. And by looking at KHC current fundamentals presented in my whole video so far, I think the risks already seem to be favorable here. I've just entered into a new position for KHC, as I mentioned in the start of my video, and I might be looking into making more bets should the share price correct even further. Till then, for the win guys, and let's make more money with more good companies like this. Alright, stay safe and see you in the next episode. Take care, bye bye.